People's perceptions of investing markets can be funny sometimes. Market valuations are inherently abstract things. It's very difficult to get a genuinely tangible, objective feel for whether a market is under or overvalued in a vacuum. We almost always have to draw on historical precedents like some sort of price to earnings ratio or the recent performance of an investment to get that idea. Generally, the idea is that if the price to earnings ratio of an investment is higher relative to historic norms, or the recent performance of an investment has been stronger than it normally is, then it may be a good idea to wait a while to invest because eventually things will revert back to the mean. And while history suggests that does sometimes end up being the case, such as the crashes that followed the Roaring '20s or the dot-com bubble, it is far from a guarantee. But there are some things that I feel often get left out of this whole invest versus wait conversation, which can influence how you see the debate. Things like how time influences how we perceive the value of investments, the likelihood and severity of market rises and market falls in general, and how much of a net benefit we actually get from waiting, even in the instances where the market does drop. So today we're going to be discussing those things and why they lead me to believe that in general, despite market valuations being relatively higher than historic norms, today still probably is one of the best times to start or continue investing. Assuming, of course, that you have things like an emergency fund in place and your debts are under control. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. Now, what exactly do I mean by time influencing how we perceive the value of investments? Put simply, I mean that in the future, history suggests that for most investment markets, we will look at today's prices and they will seem like an absolute steal. This is because, historically speaking, the majority of markets tend to rise in value over the long haul, even if not all investments individually within those markets rise over time. Now, there are a lot of reasons for this, from improvements in productivity, innovation, education, institutions, and, if we're being honest, inflation, but the point still stands. If history is anything to go by, then there's a good chance that 10, 20, or even 30 years from now, we'll look back at the prices we're seeing in most markets today and wish that we could buy them at that price. Just like we can look back at prices from 10 or 20 years ago today and wish we had the opportunity to buy them at that price. Or wish that we had bought more back then. If you don't believe me, look at these charts. Vanguard's original S&P 500 index fund has risen from roughly $20 a share to over $400 a share since the mid-1980s. Vanguard's total bond market index fund has shown a similar trend. So have funds tracking real estate, precious metals, commodities, and more. With that being said, even over the shorter term, most markets tend to rise more often than they don't. And the periods that are good tend to be more good than the bad periods are bad. Let me explain. Here's a chart showing 6 common investing markets: stocks, bonds, cash, real estate, precious metals, and commodities. The chart shows what percentage of months the markets rose in value. It also shows the median amount it rose or fell by in the months when it was up or down on an annualized basis. So you can see that stocks tend to rise at about the equivalent to an annualized rate of 37% per year in the months when it rises, and it falls by the equivalent of about 22% per year in the months when they're down. And when I say the equivalent to an annualized rate, I mean that if the investment had risen at that rate for a full year, that's what they would have ended up gaining. Volatile as the stock market can be at times, it usually doesn't gain 37% in a month, or lose 22% in a month. But it might rise by 2.5% to 3% a month, which, if stretched out over the course of a full 12-month period, would lead to a gain that would be about 37%. So that's what that means. But anyway, as you can see, the median gains are greater than the median losses for each and every asset class, and it's often by a fairly wide margin. Couple that with the fact that each and every asset class tends to be on the rise more often than they're falling, though admittedly only by a few percentage points in the case of precious metals and commodities, and you've got a pretty good combination for overall growth, even in the short term. What's more is that if you're actually regularly adding money to each of these investments, you may see your overall net worth grow even if the value of your investments temporarily take a dip. You might also get to experience what I call the investing slingshot effect when markets bounce back. The investing slingshot effect refers to how your net worth looks when plotted on a graph when you invest in markets both during and coming out of a downturn. This is a bit of an extreme example, but it'll give you an idea of what I'm talking about here. Let's say that John recently started investing. He received a small $10,000 inheritance from his grandparents and put that money to work right away. He also started investing $1,000 a year out of his own pocket into the stock market. His investments start off with a share price of $100. However, they hit a bit of a rough patch and lose 20% of their value in each of the first 2 years that John's investing. Not a great feeling, but John continues investing anyway, because he knows that selling when investments are down is generally the last thing you want to do. Over the next 3 years, John's investments would bounce back in a big way, gaining 25, 30, and then 35% over those years. After the 5 years, John's investments had appreciated to around $140 a share. That's roughly the equivalent of a 7% per year return, which is not too far off of what many broad-based stock market index funds have produced historically when adjusted for inflation. John's net worth ends up growing to a little over $22,000, and its trend looks almost like the projectile of a slingshot. At first, his net worth pulls back a little bit, just like you would pull back the string to take aim. Then when the market rebounds, John's net worth launches way beyond where it originally started, and after just 3 years, it's worth nearly triple what it was at the bottom of the market. So that's one reason why I believe that today is one of the best days to start investing, if you haven't already. Or to stay the course if you have. When you get right down to it, history suggests that a well-diversified portfolio will generally trend up and to the right over time. This is because there are more good days than there are bad days, and the good days are generally more good than the bad days are bad. You can further amplify this trend by continuing to invest during downturns, or even investing more when the markets are on sale. Which brings me to my next reason for today being as good of a day as any to begin investing. Waiting for market downturns is usually a low-value play. Now, that's not to say that there haven't been times in history where waiting to invest for a crash could have helped you come out ahead, and by a lot, because of course those days have come. The Great Recession and this most recent downturn in 2020 are examples of it. But they aren't what you would call the norm, because most market downturns are not nearly that severe. And as we saw in 2020, even when they are that severe, there isn't any guarantee that the downturn will last very long. And it can be tough to invest a bunch of money that you've been building up on the sidelines when the markets are cratering at the speed that we saw in early 2020. A combination of fear and greed can seep into the decision-making process very easily. What if the markets continued to tank beyond the 30 or so % that we saw? Obviously, now, with the benefit of hindsight, we know that they didn't go much past that, and March would have probably been a great time to buy in, but at that time, a steeper drop felt imminently possible. I saw many people predicting that we'd ultimately end up seeing a drop of 50% or more when all was said and done. And if you also heard those rumblings, and you decided to wait it out a bit and keep your money on the sidelines for another few weeks, you'd have missed out on a good portion of the benefits that you had hoped to earn by waiting to invest for a downturn, simply because the downturn didn't end up lasting very long. As it turns out, shorter and shallower downturns are the norm. And when big downturns happen, it's not uncommon to see a strong and sudden turning point that wipes out much of the benefits of waiting to invest if you miss it, just like we saw in 2020. For instance, according to estimates from Yale professor and economist Robert Shiller, when the stock market bottomed out during the Great Depression in the summer of 1932, the next 3 months saw returns of 5%, 50%, and 12%. Again, not the next 3 years, the next 3 months. During the oil crisis of the early 1970s, stocks rebounded by 8%, 10%, and 6% in the 3 months following the market's bottom. Now that time wasn't quite as extreme, but still, that's growth of nearly 27% over the course of just 3 months. And it's not just stocks that have this experience. Real estate rebounded by 34% after the market bottom in early 2009. Precious metals bounced back by 55% in the month following their market bottom in 1998. You get the idea. Bounce backs can often come suddenly, and start off quite strong, at least relative to normal growth figures. The night is darkest just before the dawn, and whatnot. Coming back to the idea of how shorter and shallower downturns are the norm, here's a chart showing the number of unique downturns, how many months they typically lasted, and the length of the longest downturn for a variety of asset classes based on historical data and estimates that I was able to find online. As you can see, even though most assets had longest downturns that stretched for several years, the only assets here that had a typical downturn lasting even a single year were precious metals and commodities. And in terms of depth, while the worst crash for all but bonds and cash are, well, pretty gut-wrenching, the typical downturn doesn't even reach double digits for anything except, again, precious metals and commodities. So while you certainly could wait to invest for the next crash, there's no guarantee that it'll happen in the near future. Remember, there are more good periods than bad. Or that you'll get a whole lot out of it when it does come. Unless, of course, you're investing an incredibly large amount of money, I suppose. Then a 5 or 10% drop could make a substantial difference. But for most of us, the difference is not usually going to be all that game-changing. This is especially true when you consider the potential income and additional shares that you'll be missing out on in the meantime, and if you take advantage of diversification and regularly rebalance your investments, since that tends to smooth out volatility. That brings me to my last point, because even if you believe that we're on the precipice of a major market downturn, which admittedly I'm not hearing a ton of people worry about that as I'm making this video, but the day will come again when those whispers get louder, so it's good to keep these things in mind as we go along. The net benefit you get from waiting to invest is often dwarfed by the benefits you'd expect to get from investing today. To figure this out for myself, I built a spreadsheet that allowed me to randomly generate returns for the various assets that we've been discussing today based on their historical performance. I ran a few different scenarios 100 times, using assumptions regarding returns I'd get with cash on the sidelines and how far I'd wait for the markets to fall before entering the fray myself, to get an idea of whether or not waiting to invest would lead to me having a larger net worth at the end of the day. I also wanted to track how much benefit I'd get if the markets really struggled, so I also looked at the greatest difference between my net worth if I started investing right away or waited to invest. Here were the results. For the 100% stock portfolio, I used randomly generated returns based on Robert Shiller's historical estimates for the S&P 500. I assumed that I had $10,000 to invest as a lump sum and would invest it when the stock market had fallen by at least 10% from previous all-time highs. And I assumed that I'd be earning about 0.5% per year on my money that was kept out of the markets, which is roughly the ballpark of many high-yield savings accounts, at least at the time of this recording. The win count column shows how many of the 100 simulations ended with a higher net worth for the investor who simply started investing right away. The typical margin of victory column shows the typical difference between the ending net worth figures after 30 years. A positive number suggests that, on average, investing right away was the better choice. A negative number suggests that waiting to invest was the better option. The biggest win column showcases the largest difference between the net worths of the two approaches across the 100 simulations. What you'll notice is that simply investing right away won more often than not. It typically won by a near $40,000 margin after 30 years, which is nothing to sneeze at, and its best case scenario was significantly better than the best case scenario for the person who waited to invest. This is largely because in some of the simulations, we got favorable returns early on, which kept the person who was waiting to invest on the sidelines for quite a while. After they got in there, they were so far behind that they really had no hope of ever catching up. A similar story could be told if you had regularly added money to your investments. I used $100 a month for the regular contribution in these examples. Or if you didn't have that $10,000 to start with and just invested out of your paycheck. The same could be said if you had a more balanced investing approach by adding some bonds into the mix to counteract the volatility of stocks. For those simulations, I put 60% of the money into stocks and the rest of it into a total bond market index fund. So as you can see, while there certainly is a chance that waiting to invest will prove to be the better choice when we look back at it with the benefit of hindsight, if history is anything to go by, then the majority of the time, it's best to start today. Because the markets have generally grown more often than they've fallen. When they're growing, they're typically doing so faster than when they're falling. And you may get the opportunity to earn income from either interest or dividends on your investments, all while buying more shares, which will help your net worth skyrocket following any downturn that you do experience. And most downturns that we'd be waiting to take advantage of don't end up being all that large at the end of the day. And it's entirely possible for us to miss out on the bottom either by jumping in too early or shortly after the rebound starts, which is important because the initial move higher tends to be fairly substantial. But what do you think? Are the risks of investing shortly before a market downturn great enough to outweigh the rewards of staying the course? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.